Hello, everyone, and welcome to Finance Concepts by your Finance-ista Cynthia Bush. Today, we are going to talk about the public markets. So the public markets are just what they sound like. They are markets where the public can easily buy and sell securities. And in the public markets, most transactions occur electronically, so in cyberspace, not physically. The public markets can be split between the primary public markets and the secondary public markets. When securities are being issued for the very first time by companies, who are also called issuers, that occurs in the primary markets. And in the primary markets, investors are buying the shares or securities directly from the issuers, but typically can also be via an intermediary, such as an investment bank. The issuer receives the money from the investors in return for the securities. The secondary markets are where securities trade after they've already been issued in the primary markets. So in the secondary markets, typically investors are trading with one another, and the issuing company doesn't receive money from these transactions. The exception to that would be if the issuing company is also in the secondary markets buying or selling existing securities. So let's look at the main players in the public markets. We have the stock exchanges, buyers and sellers, and intermediaries like investment banks. So the stock exchanges function very similarly to eBay or Craigslist. They serve as clearinghouses where buyers and sellers can transact securities transactions and exchange them with one another. This chart by Visual Capitalists shows some of the major stock markets around the world. There are over 60 of them, but approximately 20 or so are the largest, and some of these names you may recognize. So investors in the public markets can be anyone who has an interest in buying or selling securities and has the financial wherewithal to do so. The sellers in the public markets are in the primary markets. They are the companies who are issuing the securities for the very first time. In the secondary markets, the sellers are anyone who is selling securities that they own. Typical issuers in the public markets are mostly growing or mature companies, but not normally startups. And when a private company issues equity securities for the very first time, it becomes an IPO after that. It becomes a public company after that process, and that process is called doing an IPO. If you're interested in learning more about IPOs, see my video on that topic. So here is an example of large existing public market issuers. Notice you may recognize many of the companies on this screen. In the US, the public markets are heavily regulated by the US government and have significant filing requirements. The stock exchanges also have their own requirements that listed companies need to abide by. Securities in the public markets are broadly available to anyone and will usually be sold and held by many investors, so hundreds, thousands, or millions of people. That's a big difference from the private markets, which have a much more narrow distribution and availability. And if you're interested in learning more about the private markets, see my video on that topic. For the public markets, distribution is usually indirect, both in the primary and secondary markets, because there's normally an intermediary involved. In the primary markets, the issuers or companies generally hire investment banks to find investors. In the secondary markets, where securities are traded, normally Both buyers and sellers are using intermediaries such as brokers. So that's all on the public markets. Thank you for spending time with me, your Finance-ista Cynthia Bush. Please be sure to subscribe to my YouTube channel.